This is Brent from Wolf on Wall Street Trade with a market update for the week ending March 8th, 2019, and this is a weekly chart of the S&P 500. So last week we ended with some potential bearish reversal candles. These were hanging mans over here, you can see it, and this is this week. So the S&P is down 2.16%. That is a bearish engulfing candle, which means it opened the week up here above last week's close and then closed well below it. NASDAQ was down 1.89%. This is the Russell 2000. This was the really weak spot. So if you're a bull, this is not the kind of thing you want to see. IWM was down 4.20%, twice as much as the S&P 500. This is a daily chart of the S&P 500. So this is last week. So you can see we had 5 consecutive closes lower, all these red candles. And that means about the last 3 weeks of buyers here are underwater or have been taken out. Here you can see the S&P met resistance from right back here, Wednesday, October 17th. The high there was 2816.94. Remember, this didn't just come out of nowhere. We had some changes in character over the last couple of weeks. We had this uptrend, and then we had a break below, first in the NASDAQ right here, and then it started back testing it. Now, this actually, in my opinion, is a really brutal thing because it's a change in character, and typically changes in character precede changes in trends. This is probably one of the only spots where that wasn't true. So we kind of break this trend line and are back testing it. And I mentioned that's very similar to what happened in September before the market sold off in October. Here you can see the trend in QQQ. So at the start of September, it kind of breaks below that and it's back testing it. So the reason I say this is a brutal market is because it is an important change in character, but for people who aren't watching the trend lines, who aren't really kind of savvy with price charts, for instance, if I take off the trend line, you know, what do you see here? From the time the NASDAQ broke that trend line right about here, it actually gained 3%. The S&P made a new all-time high. Apple became the first trillion-dollar company, and that's what people focus on. You know, they're focused on what's in front of them. Changes in character lead to changes in trend. So yeah, you had about 3% more upside here while it was back testing this trend line. Then you had a 23% decline. So you choose, you know, how you want to weigh the data. I'm just pointing it out. This wasn't the only one. This was the first one to break the trend. And then as of last week's video, we had the SPY did the same thing. The S&P, the Dow Jones 30 did the same thing. And then pretty much all the cyclical or growth sensitive sectors were doing the same thing last week. So I'm going to jump to an intraday chart and show you pretty much the last 2 weeks, right from about here on the S&P 500 or the SPY. So this is a 5-minute chart of the SPY from about February 19th here. I'm really focused in on the last 2 weeks from right here. This is Monday the 25th. And this is last Monday, the 4th of March. And this chart's very busy. I have my kind of working signals still on here. I'll probably take those out later, but I want to leave them for this video. On the 25th, we opened up, gapped up on what was a trade rumor or trade news, a tweet from President Trump over the weekend. Actually, 20 minutes before the futures opened, that was sold. So that's Monday. Last weekend, I showed you this flag, and it had a measured move target for down here, 25.75, and that's what these vertical lines are. This is just the measured move. So I'm taking it from here to the flag. It gave us 25.75. It hit it right on the nose. And then as of last week's video, we ended the week with this larger bearish flag. Okay, these are smaller bearish flags here, larger bearish flag here. Here's where we opened up Monday. Again, trade optimism. The market gapped up and then sold off Monday morning. Then it tested the bottom of this larger, about 3-day bear flag, and it rolled over. So again, these are my measured move targets. This one, bigger flag, but a small target. It met that. And then this was a larger target that I had from here. And you can see the S&P came down and met it and formed another bearish flag. This target comes from right here. And this is where I kind of expected that we were going to find some support towards the end of the week around 273. And that is where the S&P came down to, or the SPY came down to on Friday and formed this other smallish bearish flag. Let me clean this up real quick. So again, here's that 2-week period starting with Monday, February 25th here, where we started to see more and more changes in trend. Remember the trend line I showed you that was broken for all the averages? For the S&P or the SPY, that trend line ran right here. So this first bearish flag consolidated right on top of it. This was a break below that trend line. So you could say, oh, well, you know, it's just a pullback. It's not a big deal. This is a pullback, but this is a bullish flag. And why is it a bullish flag? Because the preceding trend was up. It consolidates in a parallelogram away from the preceding trend, slanting down, and moves higher. This was down with a parallelogram slanting up, and then the second leg comes down here, then a larger flag. Now these aren't really true bear flags, but it is bearish price action. So you can see if you kind of delineate right here about the 25th, you can see that change in character from a bullish flag to 1, 2, 3, 4 bearish flags over the last 2 weeks. And it's not just the SPY, it's the NASDAQ, the QQQ. You can see here's that same February 25th bearish flag, break, back test it, break down again, another bearish flag, another bearish flag. The Dow 30, this is the uptrend line from the December, January low. There's a bearish flag consolidating on top of it, breaks below it, makes another larger one, breaks down, meets the measured move here, and turns over, another bearish flag. And it started another small one on Friday, not as well formed. Is it a market crash? No, it's not a market crash. Some people will call it a healthy pullback. The last time that I saw these was back here in October as the sell-off first started, and it really first started getting some traction in small caps. And that's why I warned earlier, you know, if you're bullish, you don't want to see small caps underperforming. They were down more than almost twice what the S&P was down. So if we kind of look at a closer view, I haven't seen that many bear flags since back here when the market started selling off. So if nothing else, it's a bearish change in character that goes along with the big weekly bearish engulfing candles engulfing that previous week. The one thing I will mention is that over this 2-week period, we start with a smaller bear flag here, make a larger one, and now we're getting kind of smaller ones. Most of these have met or exceeded, like this one absolutely exceeded, blew through the measured move target, and then I expected it to come down to this area. This bear flag did not get met on Thursday. It did get met on Friday morning right here. Then we put in another small bear flag on Friday, and it's got a measured move target down here around 149.25. So it didn't meet that target. Thursday, it looked like the market was trying to improve a little bit. Friday, it looked like it was trying to improve a little bit. Didn't meet the measured move target. And this is kind of an area, a pivot zone that I expected we might find some support. So being that we have small bear flags, larger bear flags, and now smaller bear flags that aren't meeting their measured move target, I suspect that this pivot here, actually let's just go to the S&P 500, is right over here around February 5th and 6th. It's the former high, and that's pretty much where we ended up the week, and that's kind of where I expected some support. So we might see some kind of bouncing and chopping around in here. It just depends on what it looks like. If we see kind of a larger flag develop, and it will look like a rally intra-week, so the market may be up 3, 4, 5 days out of the week, you know, but if it starts to take on a shape, you know, something along the lines of this, well, then you've got more trouble coming. Conversely, maybe it heads lower here. I don't have a lot of objective evidence for a good bounce here, but I'm seeing some of this downside momentum starting to fade. IWM was a lot weaker early in the week, really selling off a lot more than the other averages. And then towards the end of the week, the small caps were acting a little bit better than, say, the S&P and the Dow and the NASDAQ. So that might tell us something about a short-term bounce coming up next week. And there are some events over the weekend that might contribute to that. Now, what else stood out to me was the S&P sectors. So we have 11 S&P sectors. You've got about 8 kind of cyclical, growth-oriented sectors, and then you've got about 3 defensive bond proxy sectors. So the sectors that were down the most this week were energy. So you can see energy here. It's a daily chart. Ended with a little small candle, but this was one of the worst on the week, down 3.85%, worse than the S&P. Financials were also down. So let's pull up XLF. They were down 2.7%. Industrials were down, let's see, 2.8%, and the healthcare sector, which I don't really consider to be a cyclical, was down 3.85%. But it was kind of the subsectors to me that really stood out, especially front-end cyclicals. While financials were down 2.7% on the week, the regional banks were down 4.58%. Some other places were semiconductors. So semiconductors were down 3.19%. The transports were really bad. They were down 3.3%. Here's the Dow Transports. That's down 11 consecutive days. That hasn't happened since 1972. So now the transports ended with a little bullish hammer, and I'm going to show you a chart of the transports with some trend lines. Here they are the last 2 weeks since February 25th, that Monday, and they break that trend line, same as all the major averages I talked about before, the QQQ, the SPY, the Dow. So here's the transports breaking that trend line, right? And they form a bear flag, and then they come down into this downtrend channel. So as of last week, we had changes in character, and the trend was starting to look transitional. Now we have some actual changes in trends. As you can see with the transports, they even fell out of the bottom of this channel. I think that's going to make them short-term oversold, and they ended the day with that bullish hammer. So the regional banks, the semiconductors, the transports, the retail sector, biotechs within the healthcare sector, biotechs were down 5.62%. They were one of the first sectors to kind of break out above this range, or this zone that the S&P found resistance at. Broke out above. This is last week, 5 consecutive days down. That's a failed breakout. That's not the kind of thing you want to see in these really front-end cyclical type sectors, the semis, the transports, biotechs within healthcare. It wasn't all down. There were actually 2 out of 11 S&P sectors that were up on the week, and that news is not much better for the market. The best performing sector was utilities. So here they are, 1, 2, 3, they're up 4 out of 5 days. So while the broader market is selling off, the utilities are up. They're up about 0.75% on the week, but they are the only S&P sector that has made a new high. The only 2 sectors that closed higher on the week are defensive or bond proxy sectors. That would be the utilities, XLU here, and real estate. What else did good? Treasuries did well. This is TLT, 5 consecutive days up. So if I put this on a weekly chart and zoom in a little bit, I think we have a nice bull flag going here. So that is just another aspect of the change in character in the market. What sectors were down the most and what sectors had relative strength. It was the defensive sectors, the bond proxies, that did the best. So kind of wrapping all this up and putting a bow tie on it, that's the S&P 500 daily chart. So basically we got resistance here. We've seen a lot of market breadth deterioration in this area. And last week we've got 5 consecutive down days, and we kind of ended right at this pivot level. Let's say that's about 27.43 or so. So I'm guessing that we're probably going to see some kind of bounce or correction in here. It's what does it look like? You know, does it look like a flag? Does it look like the cyclical sectors are improving? Does it look like the defensive sectors are still strong, or treasury yields are starting to move lower? Watch what treasury yields do. I've talked about these a lot. This is the S&P 500, 60-minute again, and this is the 10-year yield. So remember, treasury yields move opposite of treasury prices. I just showed you TLT had 5 days up. So this is the 10-year yield. Last week, it was down all week. That meant treasuries were moving up, yields were moving down. You see this kind of zone of support here. That's around 2.625% for the 10-year yield. So one thing I would be watching is that if we do get a bounce off this pivot level, whether it's a rally or whether it's a consolidation like a flag, which is going to look like a rally intraday or day to day, pay attention to what yields are doing. They're sitting right here at the bottom, and for the 10-year yield, I would say a break below about 2.62%. If it moved down more, especially as the market was moving up, that to me is a major warning sign, especially because it has held the support level since the end of January. I would say that this trend has gone from strong and up to transitional to now into minor downtrend. You can see that here with the SPY. This is last week because the pivot low over here that I talked about in the last video was broken. That means we have a lower low. That creates a downtrend. It's not just the SPY. QQQ, the same thing. Small caps, the same thing. Fell out of this channel, and right down here at that kind of pivot level I was mentioning about the 5th and the 6th over here. So maybe we see a rally back to test the bottom of this trend line, or maybe even back up in here. I mean, this would be my preference for entering new short positions. I don't want to sell short new positions when the market is kind of extended short term and sitting at some support. I want it to bounce into this, show a little trouble, some resistance, or even up here, and enter the new shorts there. So we've got a market that has gone from change in character now to a change in trend, from let's say an intermediate uptrend to a sub-intermediate or minor downtrend. So I'm going to leave it there. We will pick it up Monday morning. Hope you have a fantastic weekend.